Welcome to the first episode of the podcast for the Chicago Midwest chapter of the Turnaround Management Association. I'm Jack O'Connor, 2018 co-chair of the chapter's Communications Committee, and for our first episode, we're bringing you the audio from our first breakfast forum of the year, featuring guest speakers Jeff Kilburg and Jon Najarian in a Bull versus Bear economic forum moderated by Dan Dooley. If you'd like to learn more about the TMA, you can do so by visiting our chapter website at turnaround.org/Chicago Midwest, and you can connect with us on social media through LinkedIn, Facebook, or by following us on Twitter at Chicago TMA. We hope you enjoy the podcast, and we look forward to bringing you more exciting content on this platform. And without further ado, let's get right into our January 2018 Breakfast Forum.
Good morning, everyone. My name is Kat Parker. I'm with Hyper AMS. For those of you that don't know, Hyper AMS is an inventory, machinery, and equipment appraisal firm. We do auctions, retail store closing, and inventory purchases. Today, I have the pleasure to introduce Dan Dooley to moderate these gentlemen. Dan is the principal and CEO of MorrisAnderson, where he manages the firm's distressed business consulting practice. He is an accomplished crisis manager, business operator, and debt restructurer. Dan is well known nationally within the professional community focused on distressed companies and insolvency. On to the two linemen. Jeff Kilburg, he is Notre Dame former defense lineman under Lou Holtz. He is a Mendoza College Business School grad. He is a CBOT bond, we could call him a pitmaster potentially. He is a CNBC contributor and most currently founder and CEO of KKM Financial. Next, we have Jon Najarian, also known as Dr. J. He is a former Chicago Bears lineman, also spent his time on the floor at the CBOT. He is the co-founder of Trade Monster and Option Monster. He's also a CNBC contributor and most currently co-founder of Najarian Family Office and Rebellion Partners. So come on up, guys.
Thank you, Kat. Thank you, Kat. Thanks, Kat. This one.
Yeah, Jeff's going to sit over here.
Jeff's
you stay here, but you stay there, big guy. Jeff wants to get on this side. Morning, everyone. This is going to be a little bit unusual because every time we have an economic forum, at least ones that I've participated in, we've always had an economist. And I always thought it was kind of ironic that we'd have an economist who is an academic who's never invested any money telling us about the economy. So we've actually got a couple real live ball players here, people that actually invest money and advise people how to invest money on the economy. So to me, this is kind of a really cool thing.
Oh, thanks, Dan.
So John's here on our right. Some people call him Dr. J. Jeff's here on our left, and I'm Dan. So we're going to try to get the audience involved to some degree in this, but we'll let us roll for a while with some questions. We're going to cover about 5 or 6 topics this morning. We're going to talk a little bit about the new tax law, the stock market, interest rates, abundance of capital, recession risks, and lastly, this thing called Bitcoin that Dr. J explained to me about an hour ago, and I still don't understand it. But I'm sure he understands it very, very well. So I think we're going to start out with the stock market, right, Jeff?
Good.
So let me start off with asking you, John. I mean, the market's been going like crazy, right? We're almost close to 2,600 at this point in time, 25 something. Mm-hmm. And why is the market, before the tax reform bill was passed, why is the market going crazy when the economy is only growing at 1.5% or 2% a year? How piece that together for me.
Well, all you guys in distressed debt know all too well that when people are firming up their balance sheets, as has been happening since the 2008 crisis, that they're pretty lean and mean. And unfortunately, there hasn't been a lot of hiring, even though we've seen some job growth, as you guys who probably parse through it the same way Jeff and I do. There's an awful lot in the service industry. Again, those aren't terrible jobs, but they're not the same jobs as the people that lost the 2 million banking jobs, for instance, because of the 2008 financial crisis and so forth. So
just as simple as companies are making so much more money because they slimmed down. Is that
demand, luckily, and I think one of the things we could definitely point to would be Brexit. Because up until then, the reason I say that, folks, I'm not making a comment on if it's good or bad for Great Britain or the Eurozone, but it changed the thinking within the banking sector of the Eurozone. So Mario Draghi, the head of the ECB, the European Central Bank, he all of a sudden wasn't hitting them as hard on the punitive side, because you all have seen when money gets tight and you've got a bad debtor out there, like, for instance, Greece and some of the other countries in the Eurozone, they were really playing hardball with them, partially because of Chancellor Merkel, Angela Merkel, and what she was doing, because her constituency was pretty angry about paying for for the things that they were having to pay for, saying, man, the Greeks seem to be living pretty good, and they keep borrowing $1 billion from us, mainly from the Germans. We're not real fond of this particular business model. So they were hitting the Greeks very hard, putting really onerous conditions on them for each tranche of money that they draw. So that changed with Brexit, and it changed like a light switch flipping, in my opinion. And I think the reason was they were afraid that the zone could break up. Because when Great Britain did vote for Brexit, which was a surprise to many, that really, I think, Dan, was a tipping point.
So Jeff, Brexit was a good thing for the U.S. economy?
Well, initially, I think
isn't that the takeaway from that?
It is, because that meant that credit became looser instead of just tightening it down to,
So Jeff,
squeezing
tell me a little bit
last
more about this.
And it took a little bit of a while to digest that. The initial reaction you saw, the equity markets here domestically really react in a negative manner when Brexit came out, that surprise vote.
Because of the uncertainty of it?
Because of the uncertainty. And I think it rewinds, let's look at the uncertainty, rewind to the election. That night we saw in the election, the S&P 500 was down 100 points. And I think the bigger picture, your question about the economy and how we're doing right now, today's another record high. We are in what I'm going to play the part of the bear today, by the way, and John's going to play the part of the bull. But I'm going to talk about being the melt-up we are.
I'm not sure what animal I am, but we'll talk about that later.
We'll talk about that later. But nonetheless, if you look, President Trump is claiming the stock market, and we can sit here and probably blow through lunch and dinner arguing that, but if you look at where the stock market has been since last November, we're up over 44% since that night. Obviously being down 100%, 100 handles in the S&P. Now we're knocking on Dow 26,000, and today's a big day talking about earnings. So to kind of bring it back to the earning landscape, certainly the U.S. economy has become more efficient since the crisis. We're able to do a lot more with a lot less, and that's going to have ramifications on job. And if you look at the unemployment rate right now at 4.1%, historic lows. And that cycle that we always talk about, not to put on my economist hat, but that low unemployment typically is followed by lower than average returns in the stock market. And I know what gets this room excited is a little bit of a pullback, maybe a little bit of distress. That's kind of a buzzword here, right? So I'm in the camp that we definitely have seen just a sensational move up, and it has a lot to do, we can dig a little bit deeper about volatility and the lack of volatility, but right now it seems like the market is overheating. And actually Fed Dudley came out yesterday, genius, come out yesterday after this move up, stating the fact, well, maybe we're overheating, maybe there's too much easy money. And that's obviously indicative in the forward guidance. Look at JP Morgan or Wells Fargo talking today about that forward guidance.
Let's talk for a second, Jeff, about multiples, stock market multiples. People talk about price-earnings ratios. In our world, they talk about EBITDA multiples in terms of valuations of companies. I don't have any statistical evidence for this, but my belief is that the value of companies in today, 2018, compared to, let's say, 10 years ago, 2007 or 8, that multiples are higher right now, that the market is valuing companies at a higher level. It's not just earnings, but the valuation. Is that true? And if so, why is that?
Well, it is true. And certainly markets are overvalued. But as we know, markets can stay overvalued for quite some time. So statistically speaking, luckily I have a couple statistics here to back you up here, Dan.
Way to go, Jeff.
But we like to, Robert Shiller, I imagine a lot of you folks are familiar with Robert Shiller, his CAPE ratio. So we are above 30. This is the highest we've been, and there's two other exceptions. We've seen the CAPE ratio go above 30 and stay above 30. 1929. I don't think I need to talk about 1929. But we also saw 1997. Why is 1997 important? Well, that overvalue 1997 persisted until 2002. Then we saw a repricing of the NASDAQ. But my point being is that, yes, the stock market, if you look at from a CAPE ratio, forward earnings, tax reform obviously dropping more bottom line to the S&P 500, it is overvalued, but it can stay overvalued longer. Wouldn't you agree, Doc?
I would. And I think one of the things that I wish had happened a lot sooner, folks, and we get to talk about this, Jeff and I do on television a lot, as far as the tax cut. Is it necessary at this time? And I said it was necessary 8 years ago. I wish it would have happened under President Obama. But there was this just real butting of heads with the Republicans about, I'll reform corporate tax, which everybody knew was out of line with the rest of the world, but I'll only do it if you raise the rates on the richest or the highest wage payers. And the Republican Congress wouldn't go with that. And so for 8 years, they basically just kept leaving money overseas rather than repatriating it. And now that's about to change. I wish, like I say, it would have happened 8 years ago. I think if it would have, President Obama would go down as one of the best presidents in history. But because he dug his heels in so hard on this issue, we've had the tepid growth that we've seen over the past 8 years. Now, we'd always have a little bit of a both V-shaped bottom when you go down as hard as we did in the S&P 500, traded down to 666. And now, to Jeff's point, we're pushing, 2,700 in the S&P and so forth. That's an amazing move from 2008 and the Lehman failure, Bear Stearns and Lehman failures, into March of 2009 when it really bottomed, when we hit that 666 or when the Dow Jones Industrials were 6,000 or whatever it was back on that particular time. So you expect a V-shaped recovery from there, and we did get that in the stock market, but we didn't get it in the economy. And I think had we addressed this tax issue back then, I think we would have had an unbelievable 8 years, not just in the stock market, because we've had that. We have had that. And all of you who have been in the market through whatever means, ETFs, mutual funds, hedge funds, whatever it is, you've done very well. Knock on wood, all of us have done very well in the market. But if you're not somebody in the markets directly or indirectly through, your 401k or whatever, it hasn't been a recovery that you've felt. And I think that's partly why, Jeff, we had Trump win the election.
If I could just add on one
people felt left out.
Well, and I think it's a 1-2 punch. Certainly the tax reform, the lack of tax reform has been a logjam. Now the expectations in 2017 that this tax reform was coming, the logjam has opened up. But I also think it's been the Fed. The Fed has allowed this easy money, these low interest rates. I mean, the 10-year, it's hard to believe it's 2018. And the 10-year, even with its 10 to 15 basis point move in the last week or two, it's at 255. So I think the Fed has really been accommodative, and that has kind of created an environment. And I'm going to go to my next slide here, Dan. But we talk about volatility a lot. You probably hear VIX. Dr. J talks about VIX all the time on CNBC's halftime report, and it is a great measurement. And if you think of VIX, if you don't have a full understanding, Doc can break it down even better. But a VIX at 16 is representative of a 1% move in the S&P 500, either up or down. But that's the expectation for the next 30 days that the stock market is going to move up or down 1%. VIX is 16. Last year, and let's remember, that's the VIX, which is implied. Realized volatility is what the actual stock market is doing, the actual movement. Yesterday it was up 57 basis points, right? So that's the realized component. In 2017, I'm trying to bring it in here, Doc. In 2017, we saw an annualized volatility of 3.9%, the lowest ever on record. And what did that do? That made the Dow Jones have 71 record new all-time highs. It provided a historic 12-month year consecutive gain. We're on our 14-month right now, another new all-time high. And my point, bringing it back to tax reform, this new tax reform, and the accommodative Fed policy, is that we have moved the pendulum. Arguably, the Fed has created a third mandate. We're supposed to have two mandates, but the third mandate is creating asset value through the stock market. They're trying to create that wealth effect. And I think that wealth effect is being played out as we speak today.
Let's talk about a different variant in the stock market. The other thing, you described the volatility, also described the index that indicated that we are at a higher earnings ratio than historically has been the norm. Is there also more leverage in the market right now, debt to equity, debt to total capital, than there was, let's say, 10 years ago? Are companies in general have more debt on them today?
No.
It got cleaned out in the crisis.
The answer to that would have been yes.
They've cleaned up, like I say, balance sheets, Dan. Our banks are right now the strongest banks in the world. And I know you're not talking just about banks, but I'm just going to use them as a quick example because Wells Fargo and JP Morgan announced earnings today. And they got right-sized, which was bad for employees, but they got right-sized and took their risk way down and basically were forced out of a number of businesses that they used to be in that were riskier businesses. Mm-hmm. And now when you see them report, it's really the fixed income trading over at JP Morgan and so forth and the foreign exchange. That's really most of what JP Morgan is hanging its hat on these days. And we can get into that with the Bitcoin discussion because that's part of the FX, the foreign exchange, because now there's not just fiat currencies that are being exchanged around the world, it's all the cryptocurrencies.
John, I was actually going a little bit. I was actually going a little bit of a different way. Not necessarily whether banks are more risky, but whether or not companies, operating companies, have more debt as part of their capital structure today than historically is the case. Is that not the case, or is that the case? You guys know?
In S&P 500 perspective, they have less debt and less leverage than they used to, but certainly when you're seeing, if you look at the tax reform that just came out,
yep,
that is going to free up a lot of different components of those companies. So to answer your question concisely, no. I think pre-crisis, there was a lot more leverage in the system, and specifically what was in the banks and focused on the financial, that trickled into every company.
Okay. Let's roll to interest rates.
Sure.
So, Jeff, Fed's raised the federal funds rate, 3 times the last couple of years?
Yep.
So 75 bips or something like that. What's going to happen going forward? Are they going to, after tax reform, are we going to see an increasing federal funds rate? Is it going to stay the same? How fast? What's your prognosis on that?
Well, we tried to grab Rick Santelli about an hour ago. He was on the floor. He was a little busy at CNBC, so we got Rickster here. But I always focus on the 10-year, and I started my career in the 30-year bond pit, matriculated over the 10-year, and became a market maker in the 10-year. And right now with the 10-year at 255, I think a lot of folks are looking and expecting it to be at 3%. But that same argument was there in 2012, in 2013, in 2014.
It's coming, basically.
Yes. But I think right now, it's this struggle. It's this equity market versus bond market debate. And right now, obviously, the equity market is winning because you're seeing it unequivocally go up every day. But the stock market is stating that there is a disparity, a dislocation. So my prognosis is that we're going to continue to see a flat yield curve, which is not the most ideal thing for the banking sector. But nonetheless, they've still been able to prevail with that flattening yield curve.
The flat yield curve implies that we don't expect interest rates to rise.
No, the flattening yield curve does the front end of the curve. We expect the Fed to continue. We're expecting 3 rate hikes in 2018. Maybe the market doesn't believe that third one, but that front end of the yield curve, that 2-year, is going to continue to go up. Now, the Fed's in a bit of a conundrum. They need that long end of the curve to go up with it. But if for some reason, God forbid I'm right, and the equity market does have a pullback here, what do people run and go and buy? It's that touch, that feel, that safety of U.S. Treasuries. Even right now, you're seeing a little bit of a metric component with the ECB. You're seeing the German Bund. It just moved up to 60 basis points. That sounds like a joke compared to 255, but it was at 30 basis points a month ago. So you're seeing a lot of bit of movement underneath the surface in the bond market. But Doc has talked about this 260 level in the 10-year note, which Jeffrey Gundlach talked about, but you were spot on 6 months ago and that being bounced. But right now, we're knocking on that door again. So we're at a critical moment in time from a Treasury curve perspective.
Right, and we had Kuroda, the head of the Bank of Japan, saying that they're going to keep a very loose monetary policy, which means, obviously, they're going to hold interest rates down over there. The ECB, even though they've lately been jawboning about perhaps letting rates float a little bit, they're still buying 60 billion euros a month, 65 billion. They were at 85 billion euros a month in purchases. Now they're dropping it, and they have done this months ago, not just this week, back down to 65 billion euros. And they say, we're going to keep doing that through the rest of this year. So if they're holding rates like that, and to Jeff's point, governments and central banks can try to move interest rates. And they do have an effect, of course, because they're swinging a really big stick. But the rest of the participants in the market also have a say. So to Jeff's point, with Draghi, for instance, the European Central Bank head, he hasn't changed anything with their policy, and he has said explicitly that we're going to be continuing to purchase these assets through 2018. In other words, more or less holding rates down. The German rate has come up 30 basis points from 0.33% to 0.6%, which is a big move with nothing out of the ECB. Why is that? That's just the market forces in action. The markets are saying rates are too low over here. And that's why I think our rates will start moving up as well. There was China called Bloomberg fake news this week. I don't know if you saw that, but it's not just the president, but 3 days ago, Bloomberg wrote an article saying, according to sources that they wouldn't quote, China's looking at backing off of purchases of U.S. bonds. That's when we slammed up against 260 and pulled back down now, because the very next day China said that's fake news. We're not going to cut back on our purchases. And they basically, I mean, if you Google it, you'll see it. China called Bloomberg fake news over that story. So we'll see on the interest rate front, Jeff, where it goes, but obviously people are not scared off by where rates are right now, and I don't think the 10-year, even at 2.9 and 3, is going to be a problem, and I think eventually we'll get there at the end of this year.
Let me ask how interest rates are interconnected between countries. How does what happens in Germany, for example, or in China, how does that impact what the interest rate would be in the U.S.?
Well, at the end of the day, the search for yield. Everyone's looking for yield these days in portfolios. And if you look at the 10-year and the security of that, outperforming by 175 basis points to a German bond, obviously you're going to see the money flows here. So it's a simplistic thing, but Jon brings up a great point. It's this central bank coordinated growth, and you're able to see they've moved the needle. The IMF, they've hiked their global forecast, right? And this is all unprecedented. And this is where I'm going to crawl into my bear suit a little bit. The fact that we've never been here before. We can talk about 1927. We can talk about 2002. We can talk about 1987. Which the start of this year is actually quite reminiscent of. But nonetheless, we've never seen the Fed or the global central bankers expand their balance sheet. We're above $16 trillion in balance sheet expansion. You guys scrutinize balance sheets all day long. That typically doesn't end well. And what I've seen that the Fed, they've gone from about 400 to 500 billion to over 4.5 trillion. They're talking about this quantitative tightening, and they're trying to very prudently bring it down, but they don't know how this is going to come out. These are scholars. They're not traders. They've never actually carted up a one lot or traded a portfolio. They're PhDs, which I'm not taking anything away from PhDs. I'm going to get beat up on the way out here, Doc. But the point is, this is unprecedented, Dan. We've never seen this coordination, and it's a little bit scary, to be honest with you.
In terms of the risk that it might have to the overall economy.
Yes.
Now, the contra that I'll offer on the bullish side is one of your next points, Dan, about repatriation. Because when we talk about quantitative easing, and somebody like either Kuroda in Japan or Draghi in Europe, or our new central banker here, soon to be coming in, Jay Powell, as the head of our Fed, following Janet Yellen. And by the way, I think she did a fabulous job. And I think the overall sense is right now that the $1 trillion that you get over in Europe, or the $1 trillion that we were spending basically on our quantitative easing, whether it's QE1, QE2, QE3, whichever of the Qs we're talking usually in the $1 trillion range. Now all of a sudden you have, because of repatriation, somewhere between $3 and $4 trillion that is coming back here. Now, some of it's here already, I think. And I bet many of you think so, because when the German 10-year that Jeff quoted a little bit ago, when it was 3 years ago, it was a negative yield of 50 basis points or something like that, meaning that you'd give somebody your money and know that you're going to get 50 basis points less back if everything goes perfectly. I mean, which is pretty crazy, but that's where rates were 3 years ago in Germany. Now, I think it would be unbelievable if Apple, who had $250 billion at the time overseas, be pretty unthinkable that the CFO over at Apple was investing in German bunds with those funds. I think they were probably chasing the same sort of things over here as far as we call it paper bonds. And I think that was likely. But nonetheless, that money physically staying here now, and from the repatriation, just quickly, it's 8% mandatory tax on illiquid assets. And then it's 15.5% tax on cash and cash equivalents. A lot, obviously, it's going to generate hundreds of billions of dollars for the Treasury, which is great.
How did that compare before? What the situation was before?
Well,
this?
but so they were all leaving it over there. I mean, the $3 trillion.
But there was different rates, weren't they?
Oh, yeah, if they would have brought it back, it would have been at 35%.
Right, yeah.
And now instead...
So it's like 1/3 or something like that.
Right. They can repatriate it, again, mandatory 8% on illiquid assets. So they don't even have a choice on that. But the boards of these, and I think, one thing that the president really likes to do is use the bully pulpit. He does it every day on Twitter and almost anywhere else that he possibly can. But I think he will really start calling out the boards of these companies, like Facebook, which Facebook's down $10 today, not for that reason, but because they changed something with their news feed. But you can imagine what would happen at Facebook if Trump starts calling out board members and saying, okay, why are you keeping so much overseas in cash right now? Now that our rate, we made it so competitive. What is your excuse now? Because the excuse before was that, well, the rates aren't competitive. Why would we bring it back? Now they've also changed it, as you guys know, to a territorial tax. So in other words, going forward, that's not a look back, but going forward, they're only going to be taxed on the U.S. portions, not on the global, which is a big change, and I think that'll be something that'll be interesting to watch.
And that's by and large been the reason why the bulls have been goring the bears. Now, where I stand on this side of the stage is the fact that this got priced in that Dow Jones 35% return in 2017, the S&P above 20%. I think it's priced in. A lot of folks think it's not priced in because the cash hasn't come back. So it all depends on which lens you're looking through, but that has been the primary driver in this melt-up in my mind. The tax reform, which is historic, there's no argument there, but the repatriation, it's going to produce about $300 billion for our Treasury, but we're not worried about that.
Yeah.
We're more concerned about what the effects to the economy.
So you expect there'll be literally trillions of dollars put back in the U.S. by all this money that's been basically stuck abroad because of the tax laws?
I do.
I do to an extent, but at the end of the day, a lot of these jobs that become more efficient and replaced, they're not coming back. Mm-hmm. So
I agree with that.
Does that force folks into more of a buyback mentality? Potentially. And Larry Kudlow loves buybacks, and he and I wrestle and argue about it all the time on his radio show. But I think buybacks in concept are strong, and they fundamentally support the company, but they get a little risky at these overvaluations.
Yeah, I understand. They're paying too much to buy the shares back, so to speak. What else about the Tax Reform Act, Jeff, do you see relative to corporate tax rates, individual tax rates? What change that's going to have huge implications? I mean, we were talking before this about the general perception that many people have that this didn't benefit the middle class, but it did benefit the middle class. Mm-hmm. So the argument becomes one of relativity, right? Did it benefit it enough? Did it not benefit?
Well,
what other changes do you see,
the middle
Jeff?
class certainly is going to see an uptick here. There's going to be more cash in their pocket to spend. But I look at, selfishly, I'll talk about myself, an LLC, right? So I'm a registered investment advisory firm, and I'm a flow through to myself. Well, I just saw a big drop down to my LLC level. What am I going to do with that money? I can only buy so many watches that Dr. J recommends, but after I buy that third watch, I'm hiring more people, right? I'm going to spend money on more talent, so I need to find more talent. So I think that component of the tax reform is dramatic.
So then that's an expansionary thing. So in your case, you're hiring
It's a
people.
CapEx for a small firm like myself.
Exactly. In your case, you're hiring people. If you're in a manufacturing case, maybe you're buying a plant or buying equipment or expanding in that way.
I don't know what the choice, if you look at the choice on the table from a buyback perspective or a capital expenditure, expense, you have to put the money in CapEx in my mind.
And Dan, since we have so much expertise in the room about distressed debt and so forth, since these companies are going to be able to expense in total these big new purchases and so forth, not spread out over years, but take it all right now.
Sure, exactly.
When something does happen, I imagine you guys will be buying it for pennies on the dollar. And I don't just mean debt. I mean, just like what Cat does with the machinery and so forth, because somebody expensed that thing when they bought it this year. If they're buying it in 2018, Cat, they're expensing that entire purchase right now under this new tax law. And as companies do, some of them hit bumps in the road and are forced to, consolidate, sell off goods and so forth. Could be an awful lot of that equipment coming back your way when that happens.
She's smiling right now.
Yeah, probably.
Is there any differences in the tax law, Jeff, between large corporations and the middle market? Many of the folks that work in this space here are more middle market focused than they are the multi-billion-dollar corporations. Do you see any differences at all there?
Well, I think you're above my pay grade right now when we start talking tax law, but I think the effective tax rate of the S&P 500 prior to this tax reform, it was already 27%. So we are seeing that downtick that is substantial. So I think any type of tax reform percentage drop, that just goes to bottom lines, and you're seeing it evident in if it's Walmart, if it's any other company out there giving out these bonuses, they're trying to balance and make everyone feel good about this tax reform.
So
right?
let's talk about that. We chatted about that before. I mean, that's President Trump, I guess you're supposed to say, has touted that lots of companies are going to give back in terms of bonuses, increase wages. Why are they doing that? What's the motivation behind that?
Balance.
Balance?
I think balance, and because they have to look at those employees every day. And I think I'm not going to totally say they're not altruistic and that they don't care about the employees, but I think they also care about the optics and want to see a little bit of balance. What Walmart did yesterday, folks, you guys saw it, but one-time pay of up to $1,000 for hourly wage workers. That is going to be, I think, $400 million hit to their balance sheet. And then they added that they're increasing their hourly starting wage to $11, which will be another $300 million hit. And they're doing that, I think, for the optics, which isn't bad. I'm all for that because it is going to impact those employees. And I'm in the camp with Dan that I think that maybe this is finally when we start getting the wages moving up to a better, to closer to 15. I don't know if we get there right away, Dan.
No, I think it'll take a couple of years.
Rolling up towards 15, I think, is going to be a good thing. I hope it doesn't take, a decade, but I hope.
We have a lot of factors right now in the economy that is likely to, in my opinion at least, is likely to create wage inflation. Do you see that coming at this point in time? Because one of the things that at least I've read is that one of the unusual parts of our expansion and our growth and all that is there's been really no growth in wages. In fact, I think real wages are actually down over the last 10, 15 years. But usually when you see expansion and productivity increases in that, the wage earners get some part of that, and that hasn't happened in the last 10 years. But now you got low unemployment, you got all this money coming back.
You would expect us to hit a tipping point as far as that goes.
Don't you
and
think
when
that's
it happens, then you'd expect the inflationary numbers to reflect it immediately.
Do you think that's coming in the next year or two, or when do you think?
I think it's coming this year. I don't know that we're breaking out as far as inflation. I'm not saying that, but I do think we're going to start getting a little more of a lift in wage inflation, which is a good thing to a certain extent. But I also say that a lot of us collectively on Wall Street, we haven't modeled in because we've only had the true tax code changes for the last 3 or 4 weeks. I mean, we've barely had it for enough time to do a real extensive analysis. So Delta yesterday announced that the impact's going to be not 500 million, but 800 million positive to their bottom line because of the taxes. Jamie Dimon just said after this one, and they took I think it was an impact of a negative about $1 billion this quarter, the fourth quarter that they just closed the books on. But he said going forward, this is just his earnings report today, he said this is going to drive our earnings significantly this year. And he's obviously one of the largest U.S. banks, one of the most respected bankers in the industry. And I think you're going to see more and more of that.
How about you, wage inflation, Jeff?
I think that's been the single most troubling component of this recovery for the Fed. And no one really talked about it. They continued talking from 29 up to 2014, the lack of inflation. But there was actually deflation in the economy. But we can't say the D word if you're on the Federal Reserve. But this wage inflation they're trying to stoke, it's been problematic. And Fed Dudley came out yesterday and said we're worried about overheating now. But I think that's been what the wrestling, and the fact why we've seen easy money for so long is due to the lack of inflation. And if we do see an uptick in wage inflation, they're going to be behind the curve and have to raise rates a little bit further. But whenever you see
the reason they raise rates is to cool things down a little bit. Would that be the theory on that?
Yeah, so that's what they used to do. So historically, they had to raise rates to cool down inflation, but they haven't been able to create inflation, despite the fact they've taken their balance sheet up to $4.5 trillion. So they're perplexed. And I think one of the things that's fueling, I know the Federal Reserve does not look at inflation. They strip out food and energy, which is absolutely insane, because we all have to eat and we all have to utilize gas.
Most important stuff we have.
It is, but one of the pillars, I guess, of my bear case today has been the U.S. dollar. And in 2017, everyone got the U.S. dollar wrong, including myself. Goldman and every big wirehouse said they were talking about the U.S. dollar index going up to 105, 110. The U.S. dollar index right now is at 91. And what has that done? That's moved crude oil above $64. That's helped China become just craving commodities. And that debasing of the U.S. dollar, this is the currency war. This is what happens when central bankers go at it on the wrestling mat. And right now, if the dollar, the Fed is really perplexed that they haven't been able to get the dollar to move up with the tax reform getting approved, as well as the 3 rate hikes. So right now, if we see that dollar slip under that 87, 88 level, that's a really big problem for the Fed and the new Fed chair, Jerome Powell.
Well,
I got an idea. We should buy Bitcoins, but go ahead.
True. One thing that Jeff nailed last year was when he was talking about the Saudi Aramco deal, which will, when it comes out, be the biggest company in the world. Because biggest privately held right now by the
$2 trillion valuation.
$2 trillion, not a single trillion, $2 trillion. So it's leapfrogging Apple to that level. But there's an election coming up in Russia, and so that's why when I was overseas with Jeff in October and then again in late November, we were talking with Halima Croft. She's a former CIA person, and you might see her on CNBC from time to time and other channels probably too. I think she's with RBC.
Yep.
But she has been covering crude oil and the summits in Vienna and so forth, the OPEC meetings. And she said, John, take my word for it, Putin is going to play ball with OPEC right now because he needs prices up for crude oil. Why does he need that? Because he needs to line their coffers over in Russia so it can hold on to power in Russia. So he's going to keep the production cuts, less supply, higher prices, until March. And she says then he'll let it go. If she's right, and if we see a confluence of issues in March, Jeff, I think that could cause crude oil maybe to make that big, not huge turn back down, not into the
Just
20s at all,
but you're right.
Pop back down into the mid-50s or even low 50s, because between that and the fact that it thaws out up in North Dakota, where I know they pump year-round, folks, with the Williston, North Dakota, where they have the shale production, but they've also got it in Permian and Marcellus. But up there, when it's that cold, I can't imagine that production's as good as it is after March. And I think that you'll see a lot more shale oil coming on the market, and crude oil might see a hit because of that.
Let's change the topic and let's talk about abundance of capital. Everyone talks about the overabundance of capital. I think, Jeff, a few minutes ago, you talked about trying to chase yield or find investment opportunities. There's huge money on the sidelines in terms of equity. There's huge money on the sidelines in terms of debt. The Fed's got $4 trillion of investments, if you will. How does this overabundance of capital ever get corrected? Traditionally, it's corrected when people lose money and people pull back, but it didn't seem to happen in 2008.
Well, it has something to do with the quantitative tightening. We've heard about quantitative easing for all these years. This quantitative tightening, it's a reduction in actual letting them roll off. So, you look at all the different markets out there and how they've been supported by central bankers. Believe it or not, Swiss National Bank, they're one of the largest owners of Apple, the stock. People have run out of things to buy. Japan, BOJ, they got approved in late 2015, early 2016 to buy U.S. securities via ETF. So there's a lot of different people being pushed into riskier assets they want, but this easy money, I think, has created a little bit of a conundrum for the proper pricing of either the bond market as well as the equity market. But it has a lot to do with Janet Yellen. So I know Jerome Powell, who's the incoming Fed chair, a lot of people are excited about him coming in, but he is in quite the pickle on how they reduce that in a proper manner, because once that market moves a little bit, I think the market's going to truly price in. Again, we're counting on the fact that they're analyzing this properly.
So what's driven this overabundance of capital? Is it a combination of the government delving into the financial markets by be a buyer, if you will, and created this quantitative easing plus low interest rates? Is that the underlying factors?
The low interest rates, I think, started it, right? So, if you rewind, early 2000, the Treasury market, or let's call it, the junk bond market, you were at 5 to 6%, and Treasuries were still at 4.5%, 5%.
Yep.
So that was a really nice yield, and a lot of fixed income folks, the elderly, were dependent upon that. But once they took that away, you forced people to go take on risks that they're typically not associated with. So we've been conditioned, I guess, at the end of the day in the last 10 years to go to places where we shouldn't typically be. So right now, that's why you've seen, and the last thing I'll throw on there, you've seen a lot of people really rotate into the passive index component, where people are like, hey, the S&P 500, the Dow Joneses can continue to outperform. Well, we've had a nice long run here, but there will be a repricing of those assets and that mentality.
How about you, John? What do you think about that?
Well, I think there's a real opportunity that's going to occur with, again, all those, how much of that $3 trillion, $4 trillion that comes back, Dan, ends up supplanting what Jeff's talking about as far as the roll-off, meaning that tightening that he's speaking of. Some of it's here already. The rest of it, I don't know. And at what level do they come in more aggressively buying bonds again? I don't know too many people that really want to come in right here at this pivot point, this 2.55, 2.6 on the 10-year bond. I don't know too many people that want to come in right there.
How about the impact of foreign capital? I mean, do we have billions or trillions of dollars of foreign capital in this economy that could leave if the ROI of China all of a sudden became incredibly impressive and the money just went and searched for the higher yield?
Well, when you talked about debt, China's the place with the debt. So when you said adding debt to balance sheets and so forth, whenever things slow down at all in China, you guys know it, they massively take on more debt in China, whether it's construction of cities or whatever. And I think that, all that debt that they have over there needs to be serviced and addressed at some point. I'm going to be real surprised if they can stay over this 6% level. They claim their flash PMI, GDP rather, they claim that they're still around 6.5. I'll be surprised.
Nobody believes that, though.
No, not really. I think it'll be surprising to see that much over 5 when they really do the assessment.
Yeah, it's like a guy that reports he's a 300 hitter, and you look at his statistics, and he's 185, so to speak. Let's talk about recession for a bit. You guys, bull, bear, where are we at with recession, the risks of recession?
Well, what are the risks? Right now, everyone out there sees no risks. And,
sees no risk?
Every economist out there has gotten very bullish, and you've seen the boat move. I see risk, and one of it is geopolitical. We always talk about this, and I know a week or two, President Trump was tweeting who's got a bigger nuclear button. But that is a real risk. That certainly is a real risk, and it's not priced into the market, no doubt about it. But I go back to what the risk is. It's the central bankers and the market giving credit to these central bankers that they've forecasted and planned this soft landing. Now, are they trying to put a big pillow on the tarmac for this huge balance sheet to land? Certainly they are. But if you continue to see markets go up, it's kind of the analogy I like to use, the stock market. It's like taking a basketball and putting it underwater. It just goes up every time. And every time, I got one of my managing directors in the back there, and he sees it. Every time, the other day we had a 15-handle sell-off. They buy it right back. And that's part of the easy money combination. So the risk actually built in is not everyone is participating in this rally. So everyone's waiting for this 3 to 5% pullback. And if you look at statistically, the 10 times the Dow Jones has had a bigger than 25% gain. There's been 10 times since 1950. The following year, the subsequent year, the typical pullback is 12%. On average, is about 8.7%. So the pullback is going to come. We don't know if it's going to be January, February, maybe September.
Don't you think the deeper we get into this expansion, whether it goes from 8 to 9, 9 to 10, et cetera, the likelihood of the pullback being deeper?
I do, and I think that's by and large the fact that there's more momentum, there's more panic, and everything has gotten so correlated. If you see an outflow in an XRT retail ETF, well, that triggers an algorithmic trader over in Russia to hit that. So I think the move will be more exaggerated, but that is where the opportunity is waiting. So I think it's somewhere around that double-digit 10% pullback, but it could easily go down to 18% for a picosecond. All these corrections are lasting where typically assets would reprice over quarters, months. Now it's happening over hours, if not minutes. It's really changed the dynamic of the game.
So you see, but starting off with the photo up there, Jeff, the geopolitical.
It's a nice photo, isn't it, Dan?
It is. Two of my favorite people. It's primarily geopolitical risk is what you think could change the landscape just overnight.
Yeah, and you always need one catalyst to bring out, because a lot of people are obviously in the camp that the central bankers and the coordination of central bankers, that's been a successful plan, and it has. It's moved equity valuations tremendously higher. But if you have one geopolitical risk, which unravels, and all of a sudden people start selling, booking profits, well, that kind of turns the lens on these other potential problems, which everyone's kind of just neglected.
Sure, yeah, leave well enough alone. How about you, John? What do you see in terms of recession
Dan,
risk?
even though I'm a bull for this debate, and also I am a bull for the rest of 2018 and beyond, I think it'll be a more modest year for us certainly than last year, and I'm thinking more in the 8% range this year. And one of the reasons is the unknown that I keep going back to about when the money gets pulled out and brought back. I know that's really good for us, for America. I don't know what the impact is going to be on Europe when that money's leaving. Is that one of the reasons that, to Jeff's point, that you've seen the German 10-year, even though Draghi is continuing to buy? I mean, all our guys have done is, raise rates. These guys have been still in that quantitative easing, buying assets, 65 billion euros every month. Mm-hmm. And yet you've seen that jump, that doubling from 30 basis points to 60 basis points in Germany. Is some of that because the rumblings are already happening and people are already starting to move money back from these areas? I don't know. We're going to see it over the next several earnings cycles. So it's not all going to be just right here in the first quarter that as soon as these guys declare, they're saying we've already started to move big chunks of it. And because of some of the, in particular, the illiquid assets, it's going to take them a while. But that's one of the things that I worry about as far as right now we always talk about this global synchronized recovery. Well, if their rates start moving up faster and they're not ready for it because their central bankers are going, why are the rates going up? We're shoving down and the rates are coming up. Might be coming up because they only have $1 trillion of quantitative easing and there's $3 trillion or more leaving.
Yeah, I understand. In balance. So you think about 8% next year, heavily driven by the money coming back, repatriation of money, probably supplemented by the tax law change. So you got a lot of positive things going on.
Yep.
All right. Let's conclude with one thing and then we'll open this up for questions. Let's talk about Bitcoin. And John, you tried to explain it to me a couple of hours ago, and I know I'm a dumb Irishman, but give us a shot again of explaining what Bitcoin is, what it's all about.
All right. I was lucky enough to meet one of you guys and gals who happened to be one of the biggest distressed debt people on earth, Peter Brigger. He's the head of Fortress. And I met him, and Peter sold me on Bitcoin. So I sold my soul to the devil that day.
Well, you are a bull.
Yeah, I'm incredibly bullish on cryptocurrencies, not just Bitcoin. And the reason is so many people that are unbanked around the world that can now use this to move money around, to store money without having to go into a bank. People in Africa that are moving money, for instance, Dan, and being charged 25% to do that because they are. We're lucky enough to be in the developed world where when you guys want to buy an apartment in Paris or Rome, you can wire it through JP Morgan and Jamie will only hit you for 3% or so to move from dollars to euros and do the wire. I can do that with Bitcoin literally for zero. I mean, zero, I could move. And there's a lot of places that take it now, that take cryptocurrencies. And they take it because there's less sensitivity to price with Bitcoin buyers because they've got an asset that they can only take and bring so much of that Bitcoin into fiat currency. In other words, from Bitcoin back into dollars. There's a limit to how much these exchanges will let you pull out of there in dollars. So you end up, if you're lucky enough to be in a winning position in some of these cryptos, to where maybe you have, hundreds of thousands or millions of dollars in a crypto that you only put a much smaller amount into. Number one, nobody knows your basis. There's nobody to go to because it's decentralized. So you can't just do like the United States did to Switzerland and say, you tell us who these guys are or you're kicked out of the global banking system. Can't do that because it's distributed, it's decentralized. So it was created, as you guys probably have heard, by either an individual or a group, this Satoshi Nakamoto, whatever that is. It's not a real person probably, but obviously a real person or group of persons are the people that created Bitcoin. And they did it because they were frustrated about central banks printing money at an unbelievable pace because of the financial crisis. So they basically worked on this guy Szabo's model for, what was it? Was it hash cash or whatever he called it? One of the first iterations. The latest one was Bitcoin in 2008, started trading in 2009, and he wrote his white paper and he said, this is why I've got to do it. There's got to be a limit to how much of it there is out there, and the asset will gather its value by its scarcity. So when Dan and I were talking about Warhols or Jackson Pollocks or whatever, somebody might see a Pollock or a Warhol and say, it's freaking great art, and that's easily worth $50 million. Somebody else might look at it and say, that looks like crap. $50 million? Who assesses that? The buyer does. The buyer, and if the seller's willing to sell it, that's what happens. Cryptocurrencies are the same. Do I think the Bitcoin's overvalued at 13,800, wherever it is today? No. I've owned it since 4,000. I've owned it when it hit 19,000, and I continue to trade around it. And I trade a lot of cryptocurrencies. I think they are one of the most exciting areas of finance right now. And I don't think they're going away. Korea could say we're going to stop them, but again, that'll just, the trade will happen somewhere else. All Korea can really do, and those of you who follow it know that Korea this week, it was rumored they were going to shut down Bitcoin trading in Korea. And they are the biggest Bitcoin traders on earth. It's Korea, it's Russia, it's China. Why China and Russia in particular? Restrictive currency. Can't get your currency out of the country. But they can't stop you with Bitcoin. I can walk anywhere in the world with my wallet or with a thumb drive, and I could have $100 million on it. Nobody knows. So there's an awful lot of Russians and Chinese that are moving money out of the country. One real quick, and then I'll let Jeff talk a little bit, but there was a Chinese guy that said, John, this is why this is so big. Watch this. So I went down to Chinatown, and he got a cell phone call from a money changer in China. He was going to accept renminbi or yuan over in China from this kid's father, about $400,000 worth over in China. They're big savers. And he was going to give that to his son in the United States. But you can only take $50,000 equivalent out of China each year. Mm-hmm. So how did he do it? He exchanges it. He gives it to Dan in China. Dan's on the cell phone, and he goes, okay, make the exchange. And the guy had $400,000 that he gave to the real estate broker in New York. for the kid to buy an apartment. So that's how convoluted it is when people have restrictions on currency and things like that. And those are all the people that are into Bitcoin now. Now then there are the speculators, and Peter Brigger, who I mentioned to you guys. Peter is, I can't even say how much he's got in Bitcoin, but it's a lot. And Fortress is a big investor in Bitcoin and cryptocurrencies. And I think they own Bitstamp and several other exchanges. There are 400 exchanges around the world right now. 400. You've heard of Gemini maybe with the Winklevoss twins. There's Bitstamp, there's Bitfinex, there's GDAX. Again, 400 exchanges. And then I'll let our futures expert over here, Jeff, talk about the impact of Bitcoin futures, because that makes things, not only was it an endorsement, but it also makes things better for trading.
Over to you, Jeff.
Well, and I think 2017 was the year of the cryptocurrency. You know, we talk about Google searches. President Trump certainly on the top of the list, but Bitcoin was searched more than anything else in 2017. If you look at the top 20 cryptocurrencies in 2017, on January 1st, that market cap was about $17 billion. We ended the year at $494 billion in those same top 20 cryptocurrencies. So you see the exposure it has. The CME Group as well as the CBOE have now created futures, which allow the professionals to come into the game, and that's been part of the price discovery mode. December 22nd, when the CME Group came out with those futures, we actually ticked above $20,000. Then we went down to 11,300 3 trading days later. So as we continue to see volatility, I'm not going to make an opinion like Tom Lee. Tom Lee came out when it was trading $3,000. That's why I specifically have that slide up there. And he's been absolutely right on the cryptocurrency and the price. But right now, as we kind of see the balance, there's going to be other, if it's Ripple, if it's Ether, there's going to be other cryptocurrencies that have futures to trade on. That just provides more and more exposure. But no matter where you go globally, if you're in a cafe in London or if you're somewhere in Asia, they're talking about those cryptocurrencies. And this is a way to really fight against government and transact. And I think it's definitely where it's going. But I think Bitcoin continues to be in a repricing mode. So I'd like to see it test that 11,300 level before it has the ability to go higher. But as long as the momentum and the buzz is there globally, I think a lot of these cryptocurrencies continue to move to the upside.
Super. All right, well, we got maybe 5-10 minutes max for questions. So let's start off. Aaron, go ahead and shoot.
I got one back here again.
Oh, I'm sorry, what?
I got one back here first.
Okay, sorry, we got Harold.
Good morning. One topic I'd like to hear about is the impact of immigration on wage inflation and productivity. So we are in a position to lose a large portion of our skilled workforce, and I don't think people are lining up to take those 7-Eleven jobs.
Okay, super. Ooh.
Go ahead, Matt.
I don't know what the impact is going to be, and I don't know what they're going to do as far as DACA, the DREAM Act, and so forth, sir. I guess immigration is actually back to record levels into the country. I know during President Trump's first 6 months or so, it fell dramatically, but now it's back up above record levels. So I don't know what the impact's going to be right now, and I know the 800,000 people, I think that's the number they threw out, in DACA. I think that was 800,000.
Yeah, it is.
I don't know what the impact will be for that either yet. It's a great question, sir.
Jeff,
and
anything?
again, one I haven't modeled yet.
Jeff?
Yeah, and I think the impact is certainly going to be in where they fall on the spectrum of skilled labor, right? Is it those higher skilled laborers, or is it more, at the end of the day, Americans don't want to do those lower skilled laborers. I get it. But it's going to really be important to see what type of skill set is actually being impacted by it.
Aaron.
First of all, guys, Jeff and John, thank you for coming today.
Oh, thanks, Aaron.
For years, we've talked about having folks from the network up on this stage, and we have bigger stages over the year. And it's great to have you here. It's great to start the year with this discussion. So thank you both very much for coming. My question is Brexit related. Woke up this morning, my feed is dominated by discussions from UK senior political leadership saying, well, maybe a second referendum isn't necessarily off the table. If that referendum happens and if Brexit goes away, what's the implication for the global economy?
Let's start with Jeff this time, if we don't mind. John,
Well,
sure. Be fair.
Look, it's been a windy road on Brexit, right? The initial impact was very damaging to the markets as we kind of let it all settle out and the dust settle. It's been more of a 2 to 3 year process, but if it goes away, I think a lot of the damage has been done specifically to London in that area. But I don't think the initial thought process of how damaging it's going to be is actual reality. So I think, again, it was kind of an implied volatility over a reaction at first.
John, anything?
Yeah, I think Theresa May really obviously stepped on it stepped in it when she basically tried to really consolidate that power when she thought that she could, force that early vote. And since then, virtually everything's been against her. So I don't think as many, I think if Brexit does happen, that London will still hold on to a pretty significant financial position in the world. I think the City of London and their tax-free zone and so forth would continue to attract a lot of business, Aaron. But I don't think that I can even guess at if they stay in, I imagine the euro would strengthen even more than it has.
John?
Great. Thank you. Like Aaron, I agree. Thank you very much. This has been a great way to kick off the year. Due to the nature of turnaround and restructuring, a lot of us in the audience work with highly leveraged companies. One of the components of the new tax law that hasn't been as widely publicized is the cap on corporate interest expense of 30% of EBITDA. I was curious if you guys talked about that, and do you see that as potentially having any impact on growth in the economy and leverage and everything else?
This one, John.
I'm going to have to plead ignorance to it because I don't know at all what that would be. So I'm
Jeff,
going to toss
anything
it
you know?
to
Yeah,
Jeff.
and I would jump in. I mean, we didn't see any CapEx since the crisis, right? While we've been seeing these large corporations, I know you guys are more middle market, but when we talk more larger footprint, they were so focused on the buyback. So despite the fact there's a cap, I still think that's an incremental win that they're going to try and go up to that cap because it's a really big deal when you're able to expense it all in 1 year, correct? So I think that will encourage CapEx across the band.
Okay, sir.
Yeah, good morning. Just to go back to the Bitcoin discussion, extremely interesting as long as we have you guys here. Can you talk a little bit more about the connection between the cryptocurrencies and blockchain? A lot of discussion of the interrelatedness between the two of them, the relationship of their growing assets or asset classes. What do you think as far as the effect of one on the other?
Okay, I'll take it out of the gate, but I think it's a really, really great question you bring up because there's a vast difference between Bitcoin and blockchain, despite the fact Bitcoin is being utilized as a proxy for blockchain. But John did a great job of describing what the blockchain process is and how people get incentivized to solve that blockchain, therefore process that. But the fact that if you see South Korea, if you see Merrill Lynch banning, whatever this anti-cryptocurrency sentiment is out there, to John's point, I'll let you expand on it a little bit, the blockchain is out there. These processes are already going on. That is not going to slow down. That's just going to increase. So no matter what they try and do to throttle down the cryptocurrency from a government regulation globally, I think the toothpaste is out of the tube.
Yeah, I agree. So the blockchain itself, that so-called distributed ledger, instead of a checkbook with J.P. Morgan, the example I used with Dan, you've got a checkbook that the whole world sees, but they don't know it's you. But the whole world can see that. And your private key sends a request that you want to send money to Jeff, and that hits the blockchain. Now, that entire ledger, they start solving a problem, a mathematical problem. And whoever wins, whoever solves that problem, then gets verified by everybody else on the network. Because the string of these blocks on the blockchain are getting longer and longer in the case of Bitcoin, it's becoming inefficient and it's becoming very expensive, not only from an electricity standpoint, because believe it or not, these are huge sucks of electricity. You might have seen CNBC yesterday, we had Michelle Cabruza Cabrera in eastern Washington State. Why? Because they had the cheapest power in the country in eastern Washington State, and I think they had 14,000 mining rigs, which look like server farms and things like that, just, rack after rack after rack, because the miners, the people that are verifying this, all these trades, you could call them maintainers instead of miners. Those maintainers win Bitcoins for solving that mathematical puzzle and then taking my transaction to Jeff and putting it at the end of the blockchain. And now for all eternity, that piece is right there and can't be removed. And the next trade that goes on in Bitcoin goes on at the end of that, and then so on. The thing just gets longer and longer and longer, and it gets more expensive to solve.
And once you see those 21,000 Bitcoins,
21 million.
21 million Bitcoins, that finite number, once you see all those mined, then the business is going to turn into more of a fee-based business versus actually solving and receiving a Bitcoin, correct?
Yeah, and I'd say that we've got 3 young traders that trade Bitcoin for us. They were all gamers before. Now they're trading Bitcoin and all these cryptocurrencies.
2 of them don't shave.
Yeah, 2 of them haven't even got any fuzz on their face yet. But they love it. They trade it all the time. They've gone on like 20-hour binges where they'll just trade it straight for 20 hours. Can't stop. They're addicted. So like I say, I think it's an exciting area right now. But they always emphasize to me, John, this is 2008 technology. They said, basically that's when your first iPhone came out and it was this big. They said, what do you think the 2018, the 2019, 2020 iterations of cryptocurrency are going to be? They're going to address some of the issues that they already know are problems with Bitcoin. They've had forks, as you know, Bitcoin Cash, Bitcoin Gold, Bitcoin Diamond, whatever things they want to create. And then you've got Ethereum and Ripple and literally 1,400 cryptocurrencies out there. Some of them are going to be amazingly better than what they have now. Doesn't mean that they'll be over $13,000 per coin, but some of them could be. It's just been a feeding frenzy and, that hockey stick where it's like flat like this and then it jumps, when the graph goes like that. It's amazing. And these are, I think, the hottest area of finance right now.
We've got time for maybe 2 more questions. So who do we got here, Chris? Hello, David.
Hi. Well, let me just preface my question by saying I'm a commercial real estate broker. Apologize if my question reflects that. And so I had already grown up and understood that the nightly news reported the Dow Jones average closed because it was a simple numeric reflection of the strength of the economy. My friends who were hedge fund guys explained to me that during the Obama years, it was simply Federal Reserve monetary policy, low interest rates that was driving the market, that the economy was still very fragile. But then as soon as Trump gets elected and takes office, it spikes 30%, and now we're at 26,000. So my question for you is, at what point we have to stop looking at the Dow average as a reliable indicator of the strength of the economy? And if you agree with that, we can't right now. Based on historical metrics, what should the Dow average really be?
Wow. You would think I paid you to ask this question. So we actually
well, you still could. He's still here.
I mean, slip something in your pocket on the way out. So at our firm, we'll take Bitcoin. We have the Essential 40 stock fund. So we call it the modern day version of the Dow Jones. So the Dow Jones, remember, right now, Boeing, the best stock in the Dow Jones in 2017, up over 70%. It has a nearly 10% weight. So how we view the Dow Jones to be properly approached, and we take 40 stocks instead of the 30, but we equally weight them. Every year we rebalance back to that equal weight. Right now you see Goldman Sachs at nearly 8.5%, and you see Boeing at 10%. If we see any type of pullback here, that overweight in that index is not going to be a proper reflection of the U.S. economy. So I think in 1896, when they created the Dow Jones, that was trying to make an accurate representation of the economy. But if you look at the names in the oddball component of this is the weighting of those names doesn't really represent. And you can argue that the Russell 2000 is more an accurate snapshot of the U.S. economy. Some people obviously benchmark the S&P 500, but I think the Dow is a wonky index and it presents a lot of different problems in 2018, which just weren't revealed in the 40s and 50s and 60s.
Makes sense.
Yep, I agree. I don't think that any of the major indexes are a very accurate assessment of the strength of the economy. They're the strength of those businesses, but not necessarily of the economy. And because of what we started off saying when we said so many jobs were cut and so many firms leaned up and meaned up, that wasn't good for overall for the economy, but it was good for those stocks. that and zero interest rates. And again, interest rates, even though you're in commercial real estate, that the rest of us couldn't access. So it was really good for those folks in that business, but it wasn't good for the rest of the economy. So either under Obama or Trump or Clinton or Bush, I don't think it's an accurate measure of how the economy is doing.
Okay, last question. Candace.
Great. Hi, great. Thank you again for your wonderful comments. And I occasionally listen to David Faber and Jim Cramer on my morning commute. And they were...
We can roll up our
you do
sleeves
too? So, you know, they were musing about inflation, right? So you get a lot of market commentators, and this goes back to Dan's comment about recession, looking for inflation, right? Everybody's waiting to see some real inflation. If you get some real inflation, you might get a big uptick in interest rates, and the whole house of cards comes tumbling down, right? Okay, but you've mentioned, hey, commodity pricing might be soft going further into the year. Bitcoin's hot, maybe is a substitute for gold. Talk a little bit about inflation and what you see playing out in the markets, as well as you know, your investment philosophy.
John, you're first.
I'd say that thank you for the nice comments, and I'd say we are likely to see in the second half of the year more wage inflation. And the first half, I think they're digesting it, the tax changes and so forth, and in the second half, we'll see more wage inflation. It might not be runaway wage inflation, which would be perfect for the Fed. That would be Goldilocks, that they see wage inflation, but it's not too much, not too hot, not too cold, just right. But if it is too hot, then like you say, it becomes a house of cards, because they're going to throw the kitchen sink at it. And they're going to say, damn it, we are behind the curve. We did let it go for too long. But because of the metrics that they use right now, and Jeff accurately said, they take out food and energy. Obviously, the energy component, not so much food, but the energy component right now is going to jump dramatically in all of these readings, because crude oil has gone from 52 to 64. That means we're all going to be paying more for gasoline and for various other inputs, you know, transportation costs and things like that. But they're not counting that. So until we get that wage inflation, I think we're probably still, Powell, when he takes over as Fed chairman, is going to sit there rather relaxed until he sees that.
And
Jeff,
that's
you
where,
get the final word, Jeff.
Yeah, and that's where the problem lies. And first of all, thank you for having us. This has been great. But the problem with the Fed focusing on inflation calculation without food and energy, how many people in here are paying college tuition? Right? That's been a slightly inflated number in the last 10 years.
No kidding.
When you go to the grocery store, you're seeing your bill go up. When you're going to the gas stations, I'm actually in the camp that we've seen inflation in the last year or two dramatically.
We're just not measuring it right.
We're just not measuring. We're not looking at it. They're so focused on the wage inflation, they're off the mark. And I think that's going to come back to kick them in the teeth. And all of a sudden, they're going to have a conundrum. Do they have to raise rates moving forward? The market's not going to forgive them for that. So I think we're actually in the midst of that being revealed as we speak.
Okay.
I think we could ask you guys questions all day, but certainly a round of applause for Jeff, Dr. J, and Dan. Thank you all. We appreciate it. Well done. Enjoy some last coffee or breakfast or anything you want before you get on with your day.